Welcome to everyone that's here so far. We've got a pretty good group. We've got 26 people. We're going to do a couple of polls in a minute, but I just want to give a disclaimer. I am a volunteer. I don't get any money from IBD. I'm an advocate of IBD. I've been studying it for at least 25 years, probably longer than that. But this is educational purposes only. We're not making any specific buy or sell recommendations. In fact, if you hear me say you should go out and buy a stock or you should sell a stock, don't do it, because I'm not giving buy or sell recommendations, and all investments have risk. You might even lose some money. And when that happens, please don't blame anybody. We're all in this together. We're all here to support each other. Personal responsibility is a key. And if from what you've learned from our IBD meetups, you do really well, all you got to do is say, hey, thanks, Floyd. If you lose some money, don't call me up and chew me out, I'm Sharon. Today, we went back to uptrend under pressure, which surprised me how fast things have changed lately. It is a little frustrating when that happens. So let's see if we can find the big picture. Are you seeing the big picture?
No.
Yes.
The stock market sold off sharply despite a surprise jump in weekly jobless claims as investors hunkered down ahead of Friday's pivotal February jobs report. S&P broke below support. So blah, blah, blah. I mean, it was a tough day, and some financials got slammed extremely hard today. I think one of them was down more than 60 or 70%. But you see right here, under market pulse, uptrend under pressure. And so we have been on a confirmed uptrend under pressure, confirmed uptrend, and now we're back under uptrend under pressure. So the market is still trying to figure out which way it wants to go. And so we need to have caution. So stock market today on Thursday, the Dow Industrials fell 1.7%, S&P 1.9%, Nasdaq went down 2%. The small cap Russells dropped 2.8%. And so that's why we went back to uptrend under pressure. And you can see here, they have a leaderboard stock, Macrolibre, which I believe is like the Amazon of South America. It dropped $50 today, or 4%. It's the largest e-commerce company in Latin America. So you see it's been on a really nice uptrend the whole year with a few days like today. There's an IPO called Next Tracker. And it dropped a little bit today, not a lot, but it's just something to be aware of.
Good afternoon, everyone, and welcome. My name is Ken Shreve, joined by Justin Nielsen, and on today's show, we'll talk about a rough day for the stock market. It started off okay. We got some Fed-friendly jobless claims data. Futures were slightly lower. They turned higher at the open, but it didn't take long for sellers to regain control. Really bad day for financial stocks. Let's take a look at the market here real quick. Nasdaq down 2% in higher volume, likely a distribution day there. The S&P 500 down 1.8, 1.9%. Dow down 1.7. Russell 2000 really got hit hard, down 2.6%. But there were some bright spots out there. We don't want to get too negative, so let me throw it over to Justin, who found 3 stocks to watch today.
We'll take a look at Toro, which did jump on earnings. General Electric, which made a 5-year new high, and also Iridium, that's looking like it's testing an area of support.
Pretty amazing to hear GE's CEO talk about the fact that they're not seeing anything related to a recession in terms of their business. So no surprise to see that stock up sharply. All right, well, why don't we start by taking a look at the S&P 500, and we did get a break of the 200-day moving average. It looks like volume is going to be higher, so that'll be distribution day number 5. We have been dealing with a market that has been showing signs of distribution, but this was just an ugly session.
Yeah, so not only did we get back below that 21-day moving average line, we were kind of struggling around that line. That's the green line on this chart. We, found resistance there as we were going up earlier in the day after those jobless claims came out. Remember, a lot of times we're looking at these things as bad news as good news. So there were more jobless claims, and the market cheered that. Resistance right there at the 21-day moving average line for the S&P 500. And then it was through the 50-day moving average line, eventually through the 200-day moving average line. And we undercut that low from last week. We're kind of knocking down different support levels here on the S&P 500. And, we were already having trouble getting back above these December 13th highs. And again, this is a line that you could have gone back even further to show different levels of support and resistance that this level was hitting before. So we've been talking about being in a trading range. And when you're in a trading range, you're usually looking to break one way or the other. This time we
Both the way the bulls did not want to see. All right, let's take a look at the Nasdaq week session for technology stocks. But like I said, we'll talk about the weakness in financials in a moment. But at least the Nasdaq barely holding on to its 50-day moving average here.
Yeah, we did get back below that 200-day moving average line. That December 13th high is something that I was watching here as well. We were closing above that yesterday and looking strong today. But again, here we are back below that 200-day moving average line, looking for potential support at that 50-day moving average line, which has been rising up to meet the 200-day line. I think this is a critical spot to the Nasdaq's favor. It has stayed above this low right here. So we'll see if it can continue to hold above that level.
We did get higher volume, it looks like, at least preliminary data showing higher volume on the Nasdaq and the S&P 500. So likely we'll add a distribution day count, making it 5 distribution days for the Nasdaq and 5 for the S&P 500 in recent weeks. All right, small caps also took a big hit today. IWM goes right down to its 200-day moving average, and it's still trying to hold there, but looks like some technical damage done here as well.
I feel like this one was a little bit of the canary in the coal mine because as it started to weaken, it was weakening first, even intraday last week. That weakness continued. It was the first one to undercut these lows. It did that yesterday and, it did hold, but today it didn't. And right through that 50-day moving average line, right down to the 200-day line. And so we're back down to these levels back in January. And now we have to see if it holds here. I should also mention that we have a big jobs report tomorrow. Jobs are definitely going to be in focus because the labor market is something the Fed is looking at closely to determine how aggressively they need to be coming after inflation. We could bounce tomorrow, but you certainly, I think, based on today's activity, had to take some defensive action just in case things get worse.
Yeah, absolutely. I know we lightened up on leaderboard today, lowered our exposure a little more. I think we're only about 65% invested going into today, but had to cut ties with a few stocks. All right, well, let's take a look at the Dow, which I guess on a relative basis held up better than the other indexes, but it's still, maybe it didn't hold up so well. On a percentage basis, it fell sharply and also below the 200-day moving average, holding above that 32,000 level.
Yeah. So again, when 1.5% drop is like relatively decent, that means you had a bad day in the market. But the Dow Jones Industrial Average has not looked great for a while here, even though it did have this strong move off the October lows. That was the end of its outperformance. You can see that with this relative strength line, the blue squiggly line. It hasn't been getting any traction since late December. So the Dow was the first one to get that resistance with the 50-day moving average line, just couldn't really cross that line. And that was a negative. So it's no big surprise to see that this one is also leading to the downside. But that Russell 2000 was more concerning because it speaks to a little bit of that risk off sentiment.
Yeah, no doubt. Well, money flowed out of stocks. It also flowed into bonds today. So it doesn't always happen that way, but money flows into bonds sent the 10-year Treasury yield down about 6 basis points to about 3.91% last check. The bond market has been worried about a recession for quite some time. It was interesting when the jobless claims data came out today. We really didn't see a whole lot of movement in that 10-year yield, but the 10-year yield weakened right along with the stock market today, and still a lot of concerns out there about the what many people say is a sure thing recession, and we'll have to see how that goes. Let's take a look at KRE. We mentioned the selling in the financial stocks today. Top weighted stock in the KRE ETF is SVB Financial. Stands for Silicon Valley Bank Shares, technology lender, but the selling in the financial, it was broad-based across every single subgroup, it seemed, in the financial sector today.
Yeah, here's SIVB, the ticker symbol for SVB. You might not be able to see exactly where it closed, all the way down here, down 60%. We were looking at a share offering, that was so we immediately sounded like, wait a minute, something else is going on here. This is more than a share offering. We were talking about this throughout the day. A big bond portfolio, a lot of redemptions from VC funds. They just had a lot of things going against them. You also have, Silvergate, that's one that a lot of people have been talking about with the whole crypto and digital currency problems. This one was down 40% today. So a lot of issues there where, some cracks. Getting back to KRE, this is a broad-based regional bank ETF. Even though SVB was one of the top holdings, it was only about 2.3%. All of the financials were really taking it on the chin today. And that was leading the downside. The market was looking pretty okay, but the financials were the worst. Really right.
Oh yeah, no doubt about it. I mean, they dominated the downside in the S&P 500, and it's just what the market needs. I mean, it's worried about so much right now about the economy and inflation and corporate earnings, and now you throw weakness in the financial stocks, and if there's going to be additional contagion, so not what the market needed, but hey, that's what we have to deal with. So yeah, you mentioned the jobs report tomorrow. Go out on a limb and say that it's probably going to see some volatility tomorrow, but we'll see how we end up. All right, let's take a look at Toro. This is the lawnmower maker. TTC is the symbol here, and actually had a pretty good earnings report from Toro.
I did take a small engine repair class, so I remember doing the Briggs & Stratton and the Toro lawnmowers, taking those apart, putting them together. This was a bright spot. It did have earnings. While earnings season is kind of at the tail end, you are getting a trickle here and there. Toro came out with earnings, nice growth numbers, a lot of volume here, and it cleared this 115 10, you add 10 cents of that, 115.20 is kind of an early entry here as part of this overall flat base. Only a 9% correction here. If we take a step back to the weekly chart, you can see that this is, this is held up pretty tight. You had a lot of tight action in here. That's the blue shading where you have 3 weeks tight closes. It's getting a little bit looser here, but still 9% isn't too bad. This was a bright spot there. Now, again, do you want to be buying on a day like today when the indexes are losing potential support and right ahead of a jobs report? Probably not, but it's still a good idea to be keeping an eye on those things that are looking strongest.
Yeah, I mean, this company has a tremendous track record of execution, good long-term record of growth. You can see return on equity here, 36%. And you look at revenue growth in recent quarters, that has been picking up the pace, acceleration in revenue growth. So, fundamentals matter. Toro definitely checks a lot of boxes. So not only a decent looking technical pattern here, but good fundamentals as well. Let's move on
To
to
point real quick, the earnings stability, just want to point this out. 5, this is a number that goes from 1 to 99, and 5 means that it's a more stable earnings. So yes, you did see some red numbers in here in terms of growth, but overall, the fact that you've got 11%, I mean, that's not huge, but 11% every year for 3 to 5 years, that's not too shabby. The fact that it's so stable with that earnings is also a plus.
Yeah, and that earnings growth in recent quarters has really ramped up 29%, 98%, 48% in the latest quarter. All right, let's take a look at GE, which had their investor day today. I saw one of the headlines, like I mentioned at the top of the show, that the GE CEO said that they're really not seeing any signs of a recession. Business is strong, and that fueled a bullish gain for GE, which has turned into a market leader.
You look at this, and I'm going to go all the way back here to looks like about 2018 is the last time you saw GE at this levels. Now, of course, this doesn't include dividends. The yield isn't that high on it, but still, the fact that it's taken this long for the price to get back up here, this was a big base, 48% depth. I would say right now it's extended. Looking at the daily, the time to buy this was maybe down around 69. Maybe another chance here as it took this pause, had a little bit of a handle. That wasn't much of a pullback. It didn't even come down to the 21-day moving average line, so it didn't really give you an opportunity there. Looking back at the weekly, you did get some tight action, but nothing that qualified as that 3 weeks tight. You don't see any blue shading there. It just didn't quite meet that criteria. After today, a lot of volume. They've been really trimming down, getting some of those things spun off so that they can kind of really have this focused on some of their more profitable areas. Certainly something to watch. We've been talking about how some of the industrial, aerospace, defense areas have been holding up a little bit stronger. You see the relative strength line on this has been going in a steady uptrend. General Electric, you might think of it as a slow, pokey stuff. One of the original Dow Jones industrial components.
Let's do our first poll. There's 28 of us on. If you wouldn't mind voting and letting us know where you are, I'll share the results here in just a little bit. So we got 50% of the people that responded. Have a few more of you vote and let us know where you are. We give it about 10 more seconds. So I'm going to share the results. Can you see that? You see the results?
Yes, we can see them.
Okay. Pacific wins by a mile, almost 50% Pacific. So we have 2 people from other. Who is other?
Someone want to volunteer their location?
Just unmute yourself and let us know where you're from if you're not from the U.S. Okay, I guess we're not going to do that one. So we're going to stop sharing that one, and we're going to launch this one. So in the next 6 months, you think you're going to see a higher market, about the same as where we are now, or lower? So we've got 80% of you have responded. We'll give it about 10 more seconds. Okay, so 61% expects us to be lower come fall. And, days like today don't help our sentiment at all, obviously. I'm going to stop sharing that one. Thank you for participating in the poll. I'm going to share a little something I put together for this particular lesson, and let's see if I can find. Okay, I've got to find here we go. Can you see that one?
Yep.
Okay, so we're going to do a slideshow. I put this together fairly quickly, but I think it will be informative. So we're going to talk about the leveraged ETF strategy using stochastics, where you can either use a daily chart by itself, or you can combine a daily, weekly chart. So as a quick reminder, our rules, if you're using the daily chart only, are summarized here. And basically, the main driver is if the fast line is crossing up through the slow line or crossing down below the slow line, You don't trade if the fast line is above 80 or below 10. And if TQQ or whatever leverage ETF you're using drops 10% or more, that's an automatic sell, and you can sell intraday. The second strategy is if you combine daily and weekly, if you get a buy signal on the daily chart, you quickly flip over to the weekly chart to make sure the fast line is not going down. It needs to be going either sideways or up to be a valid buy signal. And then when it comes time to sell, you just look at the weekly chart, and when the fast line drops through the slow line, that's a sell. And automatic, if the fast line, or excuse me, if the TQQ or the whichever leverage ETF you're using, if it drops 10% or more on a day, that's an automatic 100% sell, go to cash. So I went all the way through March 3rd, which was last Friday. And if you just bought TQQ at the beginning of 2020, that year you made 87%, 21, 83%, but last year you lost 78%. And so far this year, you're up 36%. For all of this time frame, 4 years and 3 months, you made $337 if you just did a buy and hold strategy. So basically it's a round trip, and none of these little orange triangles. The daily strategy are the blue dots, and there's about 6 instances where in that 4 year and 3 month period, TQQ dropped 10% or more. So we sold intraday. You can see that on this daily only strategy, 247%, 107%, down 9% last year. So far up 48%. The ending value starting with $10,000 is $96,000. You had to do 100 trades to earn that, and about $861 on the average per trade, with a compound annual growth rate of 57.2. If you don't do those 6 adjustments when TQQ dropped more than 10%, that's the yellow dots. Instead of having 96,000, you end up with 69,000. You still did 100 trades. Your compound annual growth rate's 47%. And then if you use the daily, weekly strategy, you only had 27 trades. You have about 1/4 of the number of trades. And you can see you're up 215, up 14 last year, down 18%. So far this year, up 33%. So your $10,000 turned into 73,000, and almost a 50% combined annual growth rate. This hasn't been professionally audited, but this is my best judgment on when the buy and sell signals occurred on TQQQ. There may be a little bit of disagreement on maybe where I picked a buy or sell strategy, but on this daily strategy, instead of $96,000, if you disagree with some of my trades, maybe you ended up with $90,000 or so, which is still very significant. So let's see what would happen if we use stochastics to make buy and sell decisions on individual stocks. On top of that, we're only going to use a weekly chart because I don't want to make a large number of trades. So let's look at Tesla. This is a weekly chart with weekly stochastics, and you can see I marked every buy and sell signal. In this time frame of about 50 months, we had 23 buys and sells on this weekly chart. The original stock price was $23.15. And on 3/3, the price was $197. I think today it got all the way down to about 172 or something or so. It dropped. Tesla's dropped pretty hard in the last 2 or 3 days, but on last Friday, it was 197. So if you just put $10,000 on Tesla at the beginning of 2019 and didn't do anything at all on 3/3, you're at $85,000. If you use the weekly stochastics to make these buy and sell decisions, instead of having 85,000, you end up with $186,746, or you do a better than 100% better than the buy and hold strategy. So my conclusion from looking at Tesla, it moves enough. It has enough volatility to it that using stochastics might be useful. Here is a summary table that shows every buy and sell exactly on the date and what the price was. We had a little drawdown in early 2019. Our $10,000 went all the way down to $6,500, but it quickly recovered and ended up at 186,000. So that's Tesla. And so Tesla seems to be a stock, from my look and this analysis, looks like stochastics might provide some useful signals for us. The next stock I looked at was Apple. This is again a weekly chart. I didn't mark all these buy and sell signals, but basically that's a buy, that's a sell. So if we look at Apple, you start with $10,000. Instead of 186,000, you end up with $40,000. And notice if you did a buy and hold, you were just a few dollars less. I sort of conclude from this analysis that maybe Apple doesn't move enough and maybe is not a good candidate to use stochastics for buy and sell decisions. There might be other indicators that might be better. So I next went and looked at Netflix, which had a huge haircut year in 22 last year. So again, the weekly chart, you can see where all these cross are either buy or sell signals. There were 30 trades from the beginning of 2019 all the way down to 3/3. So you ended up with $17,000. So you made 74%. And if you did buy and hold, you only made $592. And so maybe Netflix is a candidate, but that giant drawdown would be of concern. You'll notice here our $17,000 went down to $10,000, which is basically our starting value. So stochastics on the weekly chart did not move fast enough to take you from having this giant drawdown. Maybe if we would have used the daily chart, that would have helped us. This was just a quick exercise. The last one, as I said, if we use a weekly chart only, what would it look like for TQQQ? I did a very rigorous analysis. I'm confident in all of these buy and sell signal points. If you started with $10,000, so you only ended up with $26,000 on 3/3. So that's 19, 20, that's 4 years and 3 months. And so, but your compound annual growth rate is 38%. But you'll notice if you did a buy and hold, it was almost as good. The weekly chart by itself maybe isn't a proper stochastic system to use on a leveraged ETF. This is sort of a summary table that shows Tesla seems to be the star candidate here for using a weekly chart with stochastics. I don't make broad conclusions from this other than I don't think I would use a weekly chart only in this little brief analysis I did other than just for Tesla. So I guess I'll see if this generates any questions out there before we go to tonight's investing lesson. Let me know if you have a question.
Hey, Floyd, I was wondering what characteristics or traits the stock needs to have to run your strategy on, stochastic strategy. My question was, does the stock need to move fast?
If a stock is a steady performer where it has a broad uptrending range, then the stochastics may work fine, but very few stocks ever act like that. Most stocks have a fair amount of volatility, but from my brief analysis with Tesla, Apple, Netflix, and TQQ, my conclusion is if we go back and look at Apple, I went through 26 trades and I just barely did better by a few $100s than the person that just bought it in early 2019 and hung on to it. It seems like making 26 trades, that's a lot of work. And all that work didn't give you a huge benefit. So I don't know if I'm answering your question directly. I think it's worthy of analysis that if you have a stock that has a fair amount of volatility, stochastics could be one tool you use. But by the same token, you may want to look at sell rules that if a stock has a gap down, it has a 4 or 5 days in a row down, if you don't get a sell signal using stochastics, you may say, well, I want to sell that one anyway. So if we look at Netflix gave us a little bit of a warning. Netflix had a pretty major drawdown here in late 21, early 22, and then it drifted lower for a couple of months, and then it had this negative earnings report, and this thing just fell through itself. But we had a warning sign over here, and what trapped us using stochastics on the weeklies, we had a buy signal right here. So we owned it because of this upward movement that occurred on that week. And then we did not get, at least in my eyeball, I didn't see a clear sell signal before this happened. Maybe we could have avoided it if we would have sold over here. But if you look true stochastics, the sell signal didn't occur until maybe this day. And so I don't know if I'm answering the question out there. I think it's worthy of study. It is just one of a set of market type features, call it technical analysis. If you would have been using the 50-day moving average on Netflix, crossed right here, and you would have been in cash and you would have avoided all of this, even the 21-day. So the 50-day protected you from this huge haircut, whereas the stochastics had us, we caught a drawdown there. And if you'll notice right here, we had this huge drawdown. We went from $17,000 to $10,000 because of that event. So I don't know if I'm answering the question. I'll stop and see if there's a follow-up question. Okay.
Well, let's look. Can we look at let's look at the Market Smith weekly chart for TQ and QQ,
Right there.
because technically there's no sell signal there, but it's starting to feel a little hot under the collar given what the market's doing.
Let me share a screen and let's look at today's. So this is, you see this one?
Yeah.
We are just about ready to cross today. Today we dropped 5% on TQQ. If you look at the weekly chart, we're almost ready to cross. So we could, both of those can end up cross if tomorrow's another down day. But it's, so I don't know if this is where you were going with the comment, but it seems like we had a buy signal right here on 3-3, and we haven't had a sell signal yet, but it's real close to it.
Yeah, I was mostly looking at the weekly, but you make a good point here on the daily.
And then here's the weekly as of today. We had a drawdown on the fast line today, but we're slightly separated, almost the same amount as we are on the daily is virtually on top of itself. The weekly is slightly bigger gap, but see, we had a buy signal on the weekly all the way back here. Looks like around 113, and we've held it the whole time. Whereas if you are on the daily, we had a sell signal over here on, say, like 216, but a sell signal here And then we had a buy signal and sell signal. So there's been several buy and sell signals on the daily, whereas on the weekly, we haven't had any sell signals so far this year, but that could happen tomorrow or Monday. So does that cover what you were asking?
Yeah, it does. I mean,
I had a question on the sell signal that you're talking about. I see that you said it uses sell signal when it crosses, right? Because sometimes it's touching, so you have to wait one more day for the cross.
The market like this, if they were touching, I would sell.
So it's a touch, not a cross then.
A touch is good enough for me.
Because sometimes it'll touch and it'll go up again. Right?
If you're wrong, then you just buy it right back.
Okay, so
But
the rule is
a touch is good enough for me.
okay. Thank you.
Let's look at SOXL. SOXL looks very different on the weekly. You can see that we touched a couple days ago and we touched again today. If we look at the daily on SOXL, this surprises me. On the daily, the fast line just barely had a tiny downturn today. Maybe it lost only 90 cents. But if you look at the financial triple, here's the daily. We're below 10. Looks like we touched today. But if you look at the weekly crossed a day or two ago. Each of these leverage ETFs have their own personality. And just because one behaves one way doesn't mean they're all going to behave that way. If we look at nail crossed on the weekly back on 217, on the daily we're still in a buy zone. But see, if you're using the daily weekly strategy, you would have sold right there on 217. No matter what happened on the daily, you would have got out right there. If we look at FNGU, almost touching today on the daily. On the weekly, this looks very, very similar. I think TQQ and FNGU are similar. Let's look at UPRO. UPRO on the weekly crossed earlier this week. On the weekly, on the daily, they touched today. Unless someone has questions, let's look at Tesla on the weekly. If we were using the weekly only, you would not have sold today on Tesla, but this is going to turn down real fast. I don't know if we're going to see a bounce back. You notice that we had a strong sell signal on the weekly back here about 9:30. And then we got back in again about 120, and we've held it the whole time.
Floyd, one quick question on Tesla. If you were to use your system, your model as far as the sell and buy when you're buying it, what if you were to reverse it and do it the other way? When it's going down, you actually short it. There's a symbol called TSLS. But you would take advantage of that when it's going on a sell signal and just take advantage of the whole sell signal and make a profit as it's going down for you. And then just basically have a huge...
Potentially. I mean, this TSLS had a very clear buy signal over here somewhere about 216, and you would have held it the whole time. And you got in at 26 and it's 32. So,
which is going to be the precise time when you get out of Tesla to get into this for the inverse.
So that's up 23%.
Right.
I mean, it was up 5% today. There are these other tools we have where we can take advantage. You have a choice. You can either go to cash or you can go to one of these
Inverse ETFs.
So in SQQ, you can see we had a pretty clear buy signal over here. I'd say around 2.9. And we had a pretty clear sell signal on 3.3. So if you notice on 3.3, it was 36.73. And over here it was 33. So you made about 10%. This looks like a lot of money. You only made about a 10% profit on that one, but I guess 10% is nothing to sneeze at.
These days. Yeah.
Okay.
I had a question. This is Rick. You know, we talked about it. I can work to put a Thinkorswim strategy together, back testing for your daily, weekly strategy. I don't have a summary. Do you have the summary of your rules for the daily, weekly?
Yes, I do. Let me stop sharing and I'll go back.
I'm just going to grab a quick screenshot. I know you have this in the recording anyway. Yep. Okay, cool.
Any other question before I jump into tonight's lesson? Okay, we are going to do a brief lesson. It's an investor's business daily lesson. It's an old lesson, but yet it's a powerful lesson. And you see something called Investors Education Series.
Yep.
So we are going to go, title lessons, how to spot market bottoms. And a question I have is, why do we care about a market bottom? Anybody have any comments?
We want to be able to get the stock at its cheapest price, lowest price, and make the most money as it goes up.
Excellent. Great. I appreciate that, Mike. Anybody else have a thought?
We want to catch that follow through day that starts a new bull.
Excellent. Yours?
Also, you want to make sure at the bottom of the market, that's where you get the highest dividend yield for the stock. So as the stock goes up, you get to cash in on the dividend yield as well as appreciation.
Very good. The outline for this lesson prepared by Bill O'Neill about 14 or 15 years ago by his team, but I think he blessed every slide. Why market bottoms matter to your bottom line, how to use a follow-through day to spot a new uptrend. And we've had 2 follow-through days so far this year. No bull market has started without a follow-through day. Does anyone know what is significant about March 12th of 2009?
That was the beginning of the bull market.
That was the beginning of one of the most amazing bull markets in the history of mankind. You could have thrown darts and made a fortune if you would have saw that there was a follow-through day that IBD said start buying on March 12th of 2009. I think we had 10 or 11 or maybe even 12 years of just fantastic action. So we're going to talk about how do you make money when a new uptrend begins. And to profit from new market uptrends, you must know when the storm is over and the market itself tells you to buy stocks. You can't go by personal opinion, news, or your feelings. You must have precise rules and follow them. And Bill O'Neill was really big on rules. And if you can follow his rules, helps keep you out of trouble and enhance your profits. So why do market bottoms matter? Well, if you snooze, you lose. Monica said the biggest gains are made in early stages of a new uptrend. In the top stocks for that particular bull market, and they may be different stocks for different bull markets, but they usually break out fairly immediately, right at or just shortly after follow-through day. Fear and uncertainty can make you hesitate at critical times. Bull markets begin when everything looks bad. And right now, if you notice our poll, most of our folks voted that 6 months from now, the market's going to be lower, and that's possible. It's also possible that 6 months from now, the market could be 50% higher. Don't be distracted by news and personal opinions. Basically, what Bill is saying is let the charts tell you what's going on. Follow-through days give you fact-based signal to get back into stocks. No bull market is started without a follow-through day. Bill says it's the most reliable, time-tested indicator of a new uptrend. It lets you rely on rules instead of emotions. Those of you that have been with me for a while, I emphasize every month, read the big picture every single day that is published, 5 days a week. And embedded in the big picture is this thing called Market Pulse. By looking at Market Pulse a couple of hours ago, I discovered we went back into uptrend under pressure. If you read the big picture and look at Market Pulse, you'll know more than most investors. It takes the maximum of 10 minutes to find and read it. And then if you want to, you can watch the embedded video that comes out every day also, and that usually is pretty informative. And we watched about 2/3 of that video today at 1.25 speed. It takes a while to get used to it, but you could even play it back at 1.5 speed if you want to get through and look at the graphs and et cetera. So leading stocks break out narrow follow-through days. This is a Nasdaq chart way back in 2003. There's the follow-through day. And they show you the stocks that started breaking out at about that time. Notice this OVTI broke out a couple of days earlier. Are you prepared to make big gains? Have a watch list ready? IBD shows you when to get in and out. So here on 3/3/2000, we went into a downtrend. Here is a new uptrend, downtrend, etc. Right now, we have a yellow caution light when we have uptrend under pressure. And I used to know the number, and I forget what it is right now, but at least 50% of the time, if not greater than 50% of the time, when we go to uptrend under pressure, we end up going into a confirmed downtrend. Occasionally, there's a head fake, like we had earlier this year. We went to uptrend under pressure on 2/21, and then we had a follow-through day on 3/3, and then today we went back into uptrend under pressure. So what is a follow-through day? In correction, market tries to rally, and some of those rallies, their attempts fail. Successful rallies have follow-through days. Here, market in correction or market in confirmed uptrend. We're looking for that switch. Tells you when it's time to buy stocks. How to spot a follow-through day. In a correction, when a market makes new low, look for first day market close up from prior day. You know, as long as the index stays above the prior low, the attempted rally stays in place. You want one of the major indexes, like the S&P or the Nasdaq or the Dow, you want it to go up 1.5 to 2% on more volume than the prior day. Volume does not have to be above average, just higher than the day before, as long as it goes up about 1.5 to 2%. It typically occurs anytime from day 4 all the way out to day 30. It can happen as early as day 3, but that's very rare. Here is day 1 of an attempted rally. Notice this doesn't look like it undercuts here. So there's 1, 2, 3, 4, 5. So let's just look. Day 2 is a big gain. Market declines, but it did not undercut. So the rally remains intact. Days 5 through 20, market direction unclear. Be patient. In this particular example, back in 2006, the follow-through day was 21 days after this first rally day. So that's how you determine. And IBD will do this for you, and they'll tell you if we've had a follow-through day. In Nasdaq gained 19% in the next 5 months after that follow-through day right there. That's what we're looking for this year. I honestly believe this year we're going to have a run-up like that sometime this year.
Can I ask you if we can have a run-up like that, if the interest rates are going to continue to be high and higher?
I think we can have a rally like that if we get a signal from the Fed and they have a meeting where they don't raise interest rates because of whatever's happening in the economy, and the market then presumes that the increase in interest rates is over, and then we'll have a really nice run up if one of the meetings maybe later this year or early next year where they actually dropped the interest rates. That would be a catalyst for a much higher market. But the reason the market dropped this week is because Powell's testimony, and he said they call it hawkish, which means he's taking a strong stance, and he's saying if he needs to, next meeting, he'll raise the interest rates 50 basis points, whereas before he started speaking, everyone assumed it was only going to go up 25 basis points or 1/4%. So does that answer the question, Monica?
Yeah, but I have a follow-up question. In the TQQ strategy, there is a time to go to cash. According to Stochastics, wouldn't it be smart that if they're continuously raising interest rates, you just go to cash? But I'm just wondering if that would have saved me a lot of heartache.
If you did that, then you're not following the rules for the stochastic strategy. And so you have developed a Monica rule. Maybe the Monica rule would be if the Fed's raising interest rates, I should be in cash. So maybe you have your own rule that says, I'm going to follow this stochastic strategy, except when the Fed is raising rates. And so that's something each of us individually need to decide is, okay, Floyd has developed these rules. Do they work for me or not? If they work for me, great. Or would I be more comfortable? Like Rick was telling me, he looked at a possible strategy of not trading my stochastic strategy rules when TQQ was below the 50-day moving average. Or maybe for you, Monica, if the Fed's raising rates, I want to be in cash. Those are things that you can look at through experience, intuition, or back testing.
I had a question on this. Do you keep track of, for example, of 2022, if IBD, how many times it gave you a follow-through day like last year, and how many times they gave you an uptrend or downtrend? Is there a chart for 1 year letting us know how many times these events happen?
What I can tell you is how many times in 2022 they changed the market direction to confirmed uptrend. You want me to tell you how many times they did that?
Sure.
They did that 8 times last year.
In 12 months. Okay.
Yes. There was 24 market direction changes, and 8 of those were confirmed uptrend.
And then did any follow-through days at all? Were there any follow?
I didn't write down the follow-through days, but I'm sure there were many follow-through days that failed, and we went into a confirmed downtrend.
Got it. Thanks for the information. Appreciate it.
So I didn't write those down, but I'm assuming that you could look at. The problem is there could be a follow-through day on either the Dow or the Nasdaq or the S&P 500. So you'd have to look at all 3 charts.
Yeah, I usually just do the S&P 500 only.
Okay. I think last year was one of the few rare years that the Dow Jones did better than Nasdaq and S&P.
Yeah, and stocks and bonds lost money.
Okay, so let's keep going here. Breakouts. This is old data, but we want to find if we have this confirmed uptrend, what are the hot stocks? If you're listening to IBD Live or reading the newspaper, you will know what stocks are breaking out. If you look at the IBD 50, if you look at the sector leaders, if you look at the Growth 250, if you're using MarketSmith, there's plenty of tools, IBD Live, etc. You can figure out, you can really quickly figure out it. And my opinion is the cost of MarketSmith or the cost of the newspaper or the cost for IBD Live, if you find one good killer trade, you can pay for 10 years of those services just from one great trade. History, not hunches. 1974. Here was day 1, and a follow-through day was on day 7 back in 1974. So these occur typically between about 4 and 20-something days. 1984, follow-through day was on the 7th day. Market down, but doesn't undercut. So you didn't undercut this previous low. And look at this heavy volume, heavier than the previous day. 1998 follow-through day was on day 6. Over here's a follow-through day on day 5 that ended up failing. I mean, it looked like it was going to run, and then it failed. It rolled over here, and then here's another follow-through day that then continued on to success. if you got invested and you're going to lose 6 or 7%, you just liquidate your stocks and you wait for this next opportunity. You don't get discouraged. This was about a month or a month and a half later that this second follow-through day occurred in 1998. Here's 2003. Follow-through day was on the 4th day. After effective dot-com collapse, bad economic news, pending Iraq war scared off many investors, even as the market took off. Not all follow-through days lead to sustained. About 25 to 30% fail fairly quickly within a few days or weeks. So watch your distribution days. And for those of you that may not know, distribution day is just a day that an index goes down on heavier volume. So here's a failed follow-through day. Notice this is about 10 or 12 days later. And then we had a really nice day up and then the thing just rolled over. So you just have to be aware that not all of them work. And if you look at the market pulse, it will tell you how many distribution days and on which indexes we have distribution days. So it really helps you to track these things. So here's a day one rally attempt. And then you have a follow-through day. Don't rush in after follow-through. Go back in gradually in case we have a failed follow-through day that you didn't put 100% of your money in the first 3 or 4 days. To give it time to prove that it's a valid follow-through day. Identify leading stocks breaking out of sound basis. So if you're looking at, like I mentioned earlier, the IBD 50, the sector leaders, and other indicators, you will know what stocks are moving up. And build your watch list before the follow-through day. I'm going to show you something I use. Get back in gradually. Don't rush all at once. Maybe only buy 50% of a normal position. If the stock gains 2%, add 30 or 35% more. If it goes up another 2%, then put the rest of the money in, and so you're 100% invested. But if the thing rolls over, you've only committed 50% of your money. Minimize risk by making your stocks in new market uptrend prove themselves. To an investor, you get a follow-through day and stocks start breaking out. And then boom, you get distribution day after distribution day and you go, oh, I think this thing might fall apart. That's the lesson. I don't know if there's any questions about that, because I'm going to show you on a screen what I use.
Just for me, what I always remember about the follow-through days is not every follow-through day works, but every uptrend begins with a follow-through day.
Yes, every uptrend does follow. If you have MarketSmith, and I know not everyone does, it's a little bit expensive. It's like $1,400 a year. But one trade, honestly, will pay for the whole year, or maybe even if it's a really good trade, maybe it pays for 10 years. I use MarketSmith virtually every single day of the week, including weekends. I do a lot of studies over the weekend. When I have IBD Live going, I watch IBD Live every morning. It starts about 5:25 a.m. Alaska time, and I have MarketSmith open when I have IBD Live going so that I can be referring to things. If you use MarketSmith, you see this orange rectangle called Open Stock Ideas. Let's look at recent breakouts. I'm going to click on this. And if you double click on the symbol, what we can do is we can just use a space bar. Here's a company, Genulux. I don't know what they do. They've never made a penny of profit. I'm not interested in a company that's never made a penny of profit. So you just hit the space bar and we go to the next one. Comfort Systems provide heating, ventilation, air conditioning services. Look at the relative strength line. That's amazing. Look at the profits that this company is. And this green arrow means the analysts have recently increased the profit projections for this year And for next year, one thing I'll share with you is I look at the projected profits for 2024 at $7.28. And I multiply that by the low PE number, which is 18. And that 728 times 18 is $130. And the stock is trading at 145. So see, it was around 120 here a couple of weeks ago. So it's had this big run up. So I'm not so much interested in this one, although it looks like a pretty impressive company. Here's another heating and ventilation company. Wow. So they have a $3 profit, 314 times 28. So if I go 3.14 times 28, I get $87. And a few weeks ago, this was in the high 70s, and here is now in the 90s. So we might have missed this one. It may be too late. Dick's Sporting Good had a giant gap up about 3 days ago on a earnings report, although it says that the earnings were 20% less, but they must have given some kind of great projection or something for the stock to move up that much. So when I see a stock move up that much, I go, well, okay, I missed that one. If you look at the projected profits, 14 times 10 is 140, and here's 149. So it's not way above that number. Let's go to the next one, SGen. This is a company that's never made a penny of profit. So it's a medical thing. I'm not interested in a company that's never made a profit myself. MCOR, mechanical and electrical construction services. So $10 times 14 is 140.
Hey, Phillips,
Go ahead.
sorry, where are you getting your PE number on the chart? I see your profit number.
You see my cursor near the bottom right?
Yeah. Well, so I see the EPS number, but what's the other multiplier you're using?
This is the PE right here. And this is the projected earnings per share. So I take 782 times 5. Are you with me, Stuart?
Yeah, I'm sorry, I'm still not seeing the 5 on my cursor is in the way.
Are you looking at my screen?
Yeah, I am, but
You see this thing that says $49 at the top of the screen?
yeah,
Go straight all the way down to the very bottom of the screen, all the way to the
now,
bottom. See where it says play?
yeah, now I'm with you. Okay, I got you.
That's the PE right there. This is the dividend, and that's the PE.
Yeah, no, I was looking up in the chart in the upper left at the PE that says 8, but I'm with you now. Thank you.
I go 782 times 5 gives me 39. It's a $49 stock. So that's International Seaways. Here is Coca-Cola Mexico. Okay, so that's a 565. Here's CRM, Salesforce. Had a big giant gap up a few days ago. So look at this, 886 times 30 is about $260 or something. Here is at 178. It had this big gap up. Look, their earnings per share was 100% higher than the first quarter of last year. So this is what we're looking for. Notice these green arrows. The analysts have increased the earnings per share growth on Salesforce.com. If we take 886 and we take it times 30, I get $265. And the stock's trading at 178. That interests me. And on this gap up, look at the volume. On the day that it gapped up, it traded 37 million shares, and it normally trades about 10 million shares. The institutions were buying this thing hand over fist. And it got as high as 193. And here it is 178 because the market's been selling off a little bit. Here's a potential watch list stock. Look at the earnings per share ratings, 95. Composite rating, 95. Accumulation distribution, B+. This is the kind of thing we're looking for. Here's Booking Holdings. Look at these green arrows. Now, this is an expensive stock and it dropped $77 today. But if we take 154.28 times 16, that's 2,500. So it should be trading around 2,500, and that's where it is. Booking only. This seems to be a growth industry. The relative strength line was at a new high, but it rolled over today. This is interesting, but it's expensive. Let's look at Novo Disc. I like these green arrows over here on the projected earnings per share. So 5 times 30 is 150. So here's one that's trading below where it's potentially going to go. They make money. It's in the medical field, Denmark company, they make money. And so here's United Airlines. I sort of hate the airlines, frankly. Airlines just, they have so much capital invested and there's a lot of competition, and price of oil and all kinds of things can screw them up. So here's Decker's Outdoors. Here's these green arrows again, where else have increased the earnings. So if you take 2185 times 16, 349 is trading at 423. I'm not interested. Not on my watch list. Belder, First Source. You know, something seems really weird to me. It made $18 in 2022 and only made $6 last year, and they're projecting $7. And you take 7 times 2 and you get $14, and it's trading at 83. So there's something really weird going on here. I wouldn't touch this with a 10-foot pole myself. I don't know why that PE is so low. Even when they were making pretty good money, the PE was only 4 to 6. Here it is 2 to 3. So even though, let's say the PE was 6, 6 times 7 is 42, and it's trading at 83. Okay, so see the kind of stuff you can learn just by flipping through.
But what does that mean, Floyd? The PE down on the lower right there? Like the previous one had 2. What is that saying? Is that a projected PE or?
It says the PE range. I think that is the range. Let me see. If we go to a chart legend, let's see.
What is that?
Here we go. PE, quarterly high-low range. It's the quarterly high-low range of the PE. It's calculated by dividing the company's highest and lowest prices for the quarter by the latest 12-month trailing earnings. So see how I went to the legend to answer your question on MarketSmith? So
Yes,
the PE range, they take the earnings of the last 12 months and look at the highest and lowest prices in the most recent quarter. And that's how they get this 9 to 12.
Gotcha.
Previously, it was 10 to 15 and 11 to 15. So it trades around 9 to 12. And so if we take 0.77 times 10, that's 37. It's trading at 39. And it dropped pretty hard today. But I like these green arrows over here where they've increased the estimate. Earnings per share rating is 85. The relative strength rating, and that's not quite so good. Okay, let's look at Kex, Kirby. So we have a red arrow over here on Kirby, but it's still going up. 4.73 times 29 is about 137, and it's trading at 72. Engaged in inland and offshore marine transportation and the overhaul and repair. So let's look at a weekly chart. It was about $92 in early 2020. It had this giant haircut with the COVID sell-off all the way down to 34. And so the thing has been clawing its way back on a fairly decent uptrend. So the question is, what's going to happen with offshore marine transportation and the overhaul diesel engines? It's an interesting one that you might want to consider for a watch list. Here's Hub. Manufactures electrical wiring and power transmission systems for utilities. 12 times 20 is about 2. It's about 2. It's trading right about where it is expected to trade. I don't like to see a single digit earnings growth over here. I prefer double digit earnings growth. Look at the 68 and 49 with green arrows. So here's Macro Libre. I think this is like the Amazon of South America. If we take 2382 times 78, we get 1857. This baby's only trading at 1200. So this has a huge potential. Let's look at a weekly. Okay, so the weekly chart is showing us that it's done this. It's done this. And now is it doing this, and where's it headed? A very profitable company. They lost money for several years and they became profitable in 2021 at $1 a share, projecting next year they're going to make like $24 a share. So that's an interesting play. Manufactured agriculture tractors, self-propelled, AGCO. 14 times 7 is 98. It's 337, so that's a little bit. And it's only got single-digit earning growth. I like double-digit earning growth. MDU, construction, mining, pipeline, that. Here's a financial company with green arrows on the earnings. So 20 times 17 is what, about 340? And it's trading at 242. Pays a small dividend. So this is one that might be worth looking at. Earnings per share rating is 97. Timeliness is A. The relative strength is not at a new high, but financials are in a little bit of pressure right now, but this is an interesting play. And that's the last one on open stock ideas. So you see where I got that on Marcus Smith. And let's look at the weekly review. Something that I do every Saturday is I go to the William O'Neill stream. Let me show you how we do this. These are alphabetical, not as number one stock, but alphabetically. So there are 71 stocks. I'm not going to go through all 71, but for example, this stock should be trading around 90, 314 times 28, and it's at 92. Recently, it was all the way down at 70. This one was a pretty good buy. I don't know that it is today, but I don't like negative for this year. Arch Capital, that's about the right kind of price. What I'd like to do is find one that's got a huge earnings increase. I'm just hitting the space bar. You can go through these very fast. So Allegro Microsystem projecting a 63% earnings growth this year, but it's already been discovered. I mean, it's already a $45 stock. And based on earnings and PE, it's already been discovered and it's too. So I think ANET hit a 52-week high today, I think. So you see how you can just find here, this used to be called Taser. Exxon, let's say on that up to $4. 4 times 50 is 200. It's at 217. So it's about, I don't see the potential right away of this one going to 300. But notice back in June, this was an $83 stock, and now it's a $200 stock. So in about 9 months, this puppy has gone from 83 to 217. So 217 divided by 83. So that's 160% profit in about 9 months. So that's a bank. I don't like banks too much. I'm just looking to see if there's somebody that's got a giant earnings increase here. As I flip through, here's a Copa Holdings, Panamanian Air. Well, that's an airline. I don't like airlines. Oh, look at this one. Canadian Solar. This year, we're projecting 164 increase with a green arrow, meaning analysts recently increased their projection. Next year, 441. So 41 times 10 is 44, and it's trading at 41. So not a huge amount of gain possible here, but this is a company, everyone knows solar is sort of the hot button topic out there today for all the green energy stuff. So Deere, so 31.98. So let's just make that 32 times, let's say 15, should be trading about 480. So Deere has a potential for going up 15% here before too long. It pays a nice dividend. I do this every Saturday, and I refresh my watch list every Saturday. I throw away the old one and I develop a new one every week. I don't hold it over. I make it prove itself every week. This is an interesting shift for payments. They've been talking about this in IBD Live. So $3 times 30 is about 90. This has the potential, based on earnings projections, for this to be a $90 stock. And here it is, a $68 stock. You might want to think about putting this one on a watch list and look at the relative strength rating is very high. This relative strength line is higher than it's ever been on this particular chart. Composite rating, SMRA. This is what we're looking for. It trades about 1.3 million. So this is one you would want to watch. Now, if we're going to go to a confirmed downtrend, you don't want to be buying this. But this is a stock that has potential to go up 50% in maybe not too long a period of time. Last July, this was a $30 stock. So it's already gone up more than 100% since last July. I think this one hit a 52-week high about 2 days ago. I've been doing this for about 3 years, and I found some really good stocks too. So here's an interesting stock. That's 367. So it has a possibility of going up 20%. This is the property and casualty insurance business in all 50 states and DC. I like these green arrows on increased earnings. But the volume is only 169,000. I don't like that. Is this helpful to show you a way to develop a watch list?
Yes.
Okay. Luna manufactures fiber optic sensing and testing equipment. Look at these green arrows. 0.34 times, that's only about 6. Even if we go to 33, I don't see this one as a chance of going up a whole lot. It's already been discovered. It was a $4 stock. It was a wonderful stock. Or $10 stock, not so much. Lamb Weston, frozen potatoes. So this has 451 times 24. It is about 108. So it's pretty much where it's supposed to be. So I'm looking for ones that just grab my attention. So I may look at 100 stocks and I may only put 3 on the watch list.
I have a question. What's your minimum percent difference before you'll put it on the watch list?
Explain to me what you mean by percent difference.
So say you do the multiplication and it says 100 and it's at 75, so it can go up to.
I want to put stocks on my watch list that I think have a potential to go up 50%.
Minimum.
Yeah, minimum. If I find a company that's very interesting and it's 40%, I might cheat a little bit and go to 40, but I don't think I'd ever go less than 40. And I'm really looking for stocks that I'm hoping will double. My real goal is double, but I would take 50. So let's look at this one. This isn't the heating and ventilation, but this is intrusion, fire alarms, building access control systems. So I think security is becoming a bigger deal in the world. They're showing their profits up 100% this year. They're showing $1.13, and $1.13 times, let's say 36, says 40. So 40 divided by 32. So that says it's got like a 25% growth rate. That's too low for me, but I find this one to be interesting. The relative strength line is and a new high. Earnings per share rating is 97. You might find a stock like this interesting. You'd be happy if it went up 25 or 30%. Here's network security. 464 times 46 is 213. Is it 184? 213, 184. So that shows about a 15%. At 132, it was probably a screaming buy. Why this one is on Billows, I have no idea. Why does this go on someone's list when we're showing negative growth rate? Why would you even think about that? I don't understand that one.
Look at the week.
Here's another negative. This list is 71 stocks and it's alphabetical. Ooh, look at this one, RBC Bearing. 828 times, that's about 250. It's already at 229, so that's not that much growth.
And Floyd, why are you looking at 2024 versus 2023? Any particular reason?
Because the 2020, I don't know when their fiscal year ends,
Sure.
but it's published information here. And so I just grab the number and say, what does it tell me?
Plus, it's probably a little bit farther look out as opposed to being more focused short term. Is that part of your consideration?
Yeah. And I like to see both numbers double digit. I mean, something's happening in their business. Like this isn't quite as much as I want, but Sterling Infrastructure, 11 and 16. I don't like these red arrows, but in 4 times 6 is 24. Why is this stock trading at 40? And so
That wouldn't be a signal for you to short it, would it?
I do not have the personality to short, so don't ask me about it. Sorry, I can't do it. A man's got to know his weakness, or a woman. We got to know our weakness, and I don't do that. Toro, this is the one that they had on the video today. So 552 times 24, 132. So it's already run up quite a bit, but it's pretty impressive to me that the PE range 24 to 25, 23 to 27. So this one trades fairly tightly. Some of these PE ratios would be 100% difference. We're just about done. We went through 71 stocks. I'm just sort of giving you an idea of tools you can use for watch list development.
How did you get to William O'Neill's charts?
I went to Open Stock Ideas. I went to Weekly Review. It's the 5th item down.
Okay, weekly review.
Now, another way to find it is, see this menu over here? If you pull on that menu, right here, they have Marcus Smith screens. William O'Neill's the top one.
Uh-huh.
So if you use this slider bar here, and if you double click on William O'Neill, or they got Buffett and Graham and Peter Lynch, they have several here. That's how you get to it right there.
Thank you.
So it's getting close to 9 o'clock. I think it's time to open this up to final question and answers. We have time.
Floyd, I had a question on the stochastic IBD model. How far back did you go back testing it? Did you go to 1929, or how far back did you test that model?
I did it on the leverage ETFs, and they IPO'd in 2010.
No, I mean just the regular Nasdaq or the regular SPY, S&P 500.
I'd never gone back more than maybe 20 years.
Okay. And have you been using this model for a long time, or just a back test results only? Or did you actually put cash in there? How long ago are you really putting cash into it?
I've been using it about 2 years.
Okay. Thank you.
And I'm using the daily, weekly model. So I'm waiting for the signal to tell me if I need to go to cash. So that could be tomorrow or next week if the market rolls over and continues down. With daily, weekly, I like it because in the last 4 years, instead of doing 100 trades, I only had to do 25 trades. I'm more comfortable with the fewer number of trades, even though I may be giving up some performance value when I do that. Answer your question?
Yes. Thank you very much.
Okay. Anybody else out there?
If we go back to Axon for a minute, will you? AXON,
Daily or weekly?
daily.
Okay.
See, I think when we went through your formula, this seems pretty much well extended or close to it. Once you develop your watch list, my question really is, and I understand it's not just based on this formula, but how do you manage the short-term perspective of, I mean, are you setting stops at 5% or 8%? In other words, how do you stay focused on the long haul as opposed to being stopped out or getting nervous and bailing on these stocks before they reach their full potential?
Great question. And one of the first things I look at is when do they declare earnings? Because a lot of stocks will gap up or gap down on earnings. Notice that they did earnings on this day right here, and the stock ran up like $20. The earnings per share were up 52% compared to the same quarter last year. The next earnings is not until 5/10, so I want to know, when are they going to report earnings? But notice there was a gap up here on earnings. Here's a gap. There's a small gap on earnings. Here's a gap up on earnings. So the last three earnings have produced gap ups. There's a little bit of character here. I think a lot of law enforcement agencies are going to tasers, and I think they make
Body cams.
and then they have a service where they record the videos and charge the agencies for those recordings to preserve the videos, lawsuit or an incident. And so a lot of law enforcement agencies have realized through public outcry and to protect themselves from frivolous lawsuits or whatever that this axon is at the right place at the right time. And so no one knew that was going to happen. But when you see a gap up right here on 8/10/22, and the earnings were only up 16%, but we have a gap up on fairly decent volume. And then we have this gap up here. That was sort of the clue. Hey, something is going on. Even if you bought it at the close of the day at 171, here it is at 217. So I look at earnings per share. I look at growth rate of competitors. Then you have to make the decision. Are you going to do anything with options to help boost your performance a little bit or protect from the downside? Or are you going to outright buy it and say, okay, my automatic sell rule is if it's drops 6 or 7% from what I paid for it, I got to flush it out and it's gone.
I think the other thing on this one too is if you went back as far as last year, 2022, the RS lines trend is changing from starting to increase.
I mean, right here, it does this, and then it goes sideways, and then it does this.
So really, you've identified a few things on this particular stock. Obviously, that earnings trend may not work for every stock, but once you settle on the short list that you're going to invest in, then you really start probing a little more for character that we tell you when to buy or sell.
Right. I may look at 1,000 stocks and my watch list may only have 20 names on it. And of those 20 names, I may only end up buying 1 or 2 of them. But I refresh my watch list every weekend. I don't carry it over. I force myself to do that because otherwise, historically, I was finding my watch list was getting unmanageable because I was just adding names to old names. And before you know it, I had a watch list with 30, 40, 50 names on it. And you can't manage 30 or 40 or 50 names. I need a watch list of maybe 12 or 14 names or maybe 18 names at the most. And then on Friday, I throw it away. And Saturday or Sunday, I develop a brand new watch list.
I bet if you ran a survey, the majority of people on here would say they've done the exact same thing. Or in my case, still are.
I mean, if people do that, then when we get a confirmed uptrend, you're more prepared than anyone else. Now that I have a confirmed uptrend, grab my watch list stocks. Okay, on my watch list, which ones are breaking out and why are they breaking out? And do I need to jump on it and start buying it or not, you know? Or if one's broken out and it's a little higher than I wanted to, I quickly look at a competitor and say, what's the rating on the competitor and how profitable is it? And is it due to break out as maybe what you might call a cousin or a sister stock?
Floyd, when you go to all cash, does that mean you sell everything or do you keep the stocks that are still doing well with Stochastics?
Very interesting question. I own a huge amount of Apple stock, but I only paid $42 a share for. And the taxes I would owe on that would be horrendous. I go to cash on my more recent purchases or leverage ETFs, but something like my Apple is a long-term holding. And also in my company 401k that has mutual funds, I tend to stay invested in the mutual funds. When I go to cash, it is on my more actively traded stocks or my more recent purchases or leverage stocks. So does that answer your question?
Yes, thank you.
What I'm doing on Apple is I'm selling covered calls. Right now, Apple is trading at 150, and I have April calls at 165. I made many thousands of dollars when I sold those calls on the third Friday of April. If Apple is at 165 or lower, my call options expire worthless. If Apple starts going up and is approaching 165, I will roll my options to a higher price. I don't want the Apple to get called away, but I would say 3 times out of 4, when I sell call options on Apple, they end up expiring worthless, and I end up pocketing that money into my account. I've sold call options on stocks in the last 20 years, probably 1,000 different times. That's called a covered call. If you own the shares and you sell calls against the shares you own, I go to the option table and I look at a delta of about 10 or less. And that's the strike price I will choose. I usually go out 30 to 60 days when I sell my calls. Since I have so many shares, if I can get 40 or 50 cents, I'm perfectly happy. And it pays a dividend. You guys all know that I bought Chevron about 13 months ago at $129 a share. On Chevron, I have April 180 calls. And I got like $2 a share for those. 180 is right here. In 6 weeks, if it's 180 or less, my call options expire worthless. If Chevron gets up to about 175 or higher, I'll roll those 180s to probably a 190. So I'm just trying to gain a little bit of extra income. On my call options, I sort of liken it to owning property, and I'm renting the property out and I'm earning my rent from my option premium. Okay, getting sort of late. I'm impressed that 23 of you are still with us. I guess I'll leave it in case anyone has a burning question, or we're going to sign out. And thanks everyone for participating. And our next meetup will be April 13th. And hopefully Rick Hiller will have found enough information that he'll be our guest speaker, but that's tentative. I'm not promising that Rick's going to get what he needs, but hopefully he will. Any last questions?
I sent you a DM.
What's that?
I sent you a DM just now.
A message, text.
I'm not sure what you were saying, George.
Check your chat.
Oh, you sent me a chat. Oh, okay. I'm busy enough that I'm looking at my chats. Yeah, no, I've sent Mike Scott 2 emails. And I think at that address, does that look familiar, Rick? Paxson at earthlink.net?
Sorry, I'm not seeing which one that is.
Well, I'm going to write that down, George. I think that's the address I have, but I'm going to write it down to make sure. And this is Mike Scott. Because I sent both Mike and Rajiv Jain emails asking for assistance, and neither have answered. So thank you, George, for supplying that. I'll confirm that's the email I've been using. Thanks everybody for signing in tonight and hanging in there with us. I hope you found value in our lesson, and happy investing to everyone.
What was the one you said, Floyd? Paxson at earthlink.net? XSEN. Yeah, that's the one you sent to.
Yeah, that's the email we use, George. We sent him a message, I think, on February 20th and on February 27th. Either he's busy or traveling or doesn't want to respond.
Maybe try Lee Tanner because they're buddies.
Okay, I'll check with Lee and see if Lee can help me. Maybe Lee's got his phone number.
I guarantee you Lee has his phone number because they used to work together on a submarine.
Okay, sounds great. Thanks a lot.
Thank you, Roy.
Bye.
Thanks.